is the show, the Year of Commodities. I'm Mubina Kapasi. With me is Karanya Rao. And Karanya, after that massive recovery that we witnessed in 2016, 2017, it looks like the commodity complex has given a pause to that recovery. 2018 certainly was marked by heightened volatility in the entire complex. So whether it's crude oil prices, which would move from 50 to 86 and back again at $55 per barrel, or even for that matter steel prices, which entered into bear territory this week, aluminium prices, which slipped all the way from $2,500 per ton back to $1,900 per ton. And then of course we had the biggest influencer of the commodity complex. It was not Saudi Arabia, it was not China, but this time around it was President Donald Trump and his Twitter handle, and of course not to mention all the dynamic statements he's made in the year gone by, which has left the entire complex befuddled. So this is the show where we are going to look back at 2019, or rather look back at 2018, decipher all the trends that we've seen, and of course Karanya, try to outline the biggest trend of 2019 as well.
That's right, but before we do that, we have to address the biggest newsmaker of 2018 when it comes to the world of commodities, and that is the crude oil. Let's take it across to Pankaj, who's standing by to give us a detailed wrap of what transpired in the oil markets in the year gone by.
Oh boy, it's been a volatile year as far as crude oil is concerned, whether you talk about the US crude or the Brent oil. As you can see, the graph which is going on from Jan to what is happening in December. So it touched the 88 level high, 86 level high, which was a 4-year high as far as Brent is concerned. In September, everybody thought it's a consensus bullish trade. And now in December, we are down about 35% from that level. So you can see we started the year at 60. We are ending the year below 60, but in between, we went to as high as about $90 a barrel. A lot of news flow surrounding crude market, and that's the key reason why it has been extremely volatile. And it all started towards the mid-year. At the start of the year, it was a consensus view that crude will go down. But then since April, you got, Trump warning against Iran. And that was one of the key reasons, why crude started to again move up. Trump withdrawn from Iran sanction that was not taken on. In fact, the imposed sanction that was taken on quite negatively by the market, which means for the supply, it was negative. And that's why, the crude shot up. Market expected Brent oil to hit $100 by the year end. This was some of the global sell-side analysts who did it. In October, it did hit about 86 odd level, which itself was a 4-year high. You got record output in US, Saudi and Russia between October and November. And since then, crude oil prices have fallen. Trump extended 8 countries from Iran's sanction, who were one of the key suppliers or key buyers from them. Iran sanction kicked in, and now you have in the month of December oil in a bear territory, cracking about 30% from the highs as we are speaking, well below the $60 barrel a mark. I'm talking about the Brent crude. When you talk about NYMEX crude, it's below $50 a barrel, again at a 15-month low.
Okay, Pankaj, thanks a lot for that. And that's the topic that we are going to discuss first on the show. Oil prices, the kind of volatility we've witnessed, especially in the last 3 odd months of this year. So let's bring on board Michael Barry, the Director of Research at FGE London. Michael, it's great to have you with us on the show. Thanks so much for giving us your time. Just in the last 2-3 months, we've seen Brent prices crack, and with what speed. Just from $86 per barrel, we slipped to a level of $56 per barrel in the month of December. What, according to you, has been the key reason? I mean, what is your assessment of the current demand-supply situation? Because that's where everyone seems to be pointing their fingers.
A couple of months ago, I think it was actually the day that Brent hit $85 a barrel. So obviously things have changed dramatically since then. Our view then was that the price was about to peak, but it's true to say it's probably come down even faster than anyone was expecting. The main reason we say is not so much demand, although there are concerns about the demand trend. It's more supply. And back in October, there were signs that the Saudis were boosting output. And since then, in fact, it's turned out they boosted output even more in November. They actually produced 11.1 million barrels a day and supplied a bit more than that to the market. So although OPEC has agreed to cut production from January, we're not going to see that happening for a few weeks, and obviously not having an effect for many more weeks. And in the meantime, there's this huge volume of Saudi supply that is still coming to the market. And on top of that, there are signs that some of the countries in the deal who agreed to cut from January have actually been raising production since the meeting in November, partly from previous plans in countries like Kazakhstan, for example, after previous maintenance. So we actually are rather doubtful that they're going to cut the full 1.2 million BD that was agreed at the OPEC meeting recently, partly because they're going to be coming from a higher level than I think they were all assuming. So we do see it mainly as a supply problem, which could take up to 6 months to get absorbed, even if they do cut back enough.
Talking about the outcome of the recent OPEC meet, do you believe the 1.2 million barrels a day output curtailment by the oil cartel can actually help rebalance the oil market? Because which has seen Russia, Saudi pump out record levels of output. And as you're saying, if they actually do not cut the entire 1.2 million, how much, according to you, will actually be curtailed?
Well, we currently think that the actual cutback could work out at only about half that amount. And the other problem is they might even be coming from a slightly higher level in November rather than the October level, which is supposed to be the reference point. But putting that aside, even if they did cut the full 1.2 million BD, we don't think it would get rid of the current stock surplus until maybe the middle of next year. So our view is that they are almost certainly going to have to extend the deal through the second half of next year as well. Though that partly depends on what happens with the US and the waivers on Iran exports. The expectation is that after April, the US will tighten the sanctions or reduce the waivers a bit further. But that's a big unknown because nobody, not even the US, I think, knows exactly what changes they're going to make to the waivers because it will depend probably on the oil price at that time. Though our view is that if we see prices staying around current levels of let's say $60 for the next 6 months for Brent, we think the US will squeeze a bit further after April. But even then, we think that the deal will have to be extended through the second half of the year before it has a really significant effect.
Okay, so the output cuts could actually be only half of what was decided, and in all probability, they would have to be extended. A very interesting take coming in there, Michael. Let's talk about now the erstwhile joker in the pack, and that was the United States. While they have not been such an eager participant in, or rather not been such a huge participant in pumping out oil, that has completely changed in the last couple of years. Record amounts of output coming in from them. They've even started exporting a significant quantum. So do you think that, given the fact that they are not in any obligation to cut output, that would continue to put pressure on oil prices?
Obviously very uncertain what's happening to US shale output. Nobody really knows for sure, but the signs are that it is still growing faster than anyone expected. And so it's going to, the growth in US production next year is probably going to match pretty well the growth in world oil demand. So it leaves OPEC with a very sort of unchanged slice of the pie, so to speak. And this is their problem.
And as per your assessment, at what level or how soon do you expect shale producers become unprofitable or pause on operations and eventually cut supply? You mentioned we could see curtailment by shale guys in April.
Well, we're getting quite near the level, we believe, where shale producers are beginning to get exposed. I mean, we certainly think if you get below $55 Brent or down towards 50, then it is going to put some of them in a position where they start thinking of reducing operations. And our assessment of their underlying costs imply to us that the forward curve now for 2020 is probably below where they'd be able to start hedging again. So that is an issue. But on the other hand, we don't think it's actually going to mean much lower shale output. We still think it'll be growing significantly next year. I think you'd have to have prices going below $50 Brent, which we're not currently forecasting at the moment.
Okay, let's talk about another interesting characteristic of this move we've seen in oil prices, and that is the widening spread between Brent and WTI. Do you think that this is something that would sustain even in 2019?
No, we think it should narrow a bit, partly because of pipeline constraints in the US. There's a lot of pipelines coming in the Permian Basin area, but not till the second half of 2019. So we do think that the current Brent WTI spread will narrow a bit in the next 6 months, but then it probably could well widen back to where we are now in the second half of the year.
Okay, Michael, and now, of course, the million-dollar question. I'm going to ask you to do some crystal ball gazing and help our viewers understand what is it that's your outlook on Brent for the year 2019. What range do you expect oil prices to trade in the coming year?
Well, our current view is it could probably fit in a range of $55 to $70 over the next year. I mean, it might get towards the top of that range in the second half of the year. The key unknown factor, of course, we haven't mentioned so far, is the Trump factor, because he obviously is putting pressure on the Saudis and other OPEC countries to keep prices down. And so we do wonder, actually, whether $70 may not reappear unless there's some major problem or unexpected difficulty in supply somewhere. In a fairly sort of normal world next year, we're probably looking, we think, at around $60 Brent as a typical average.
Okay, great, Michael. It was lovely chatting with you. Thanks so much for joining in on Year of Commodities and giving us a snapshot of the year gone by and what we can expect going forward. Supply side issues, more than demand, having to do with the crack that we witnessed in Brent prices in the year gone by. Well, we'll take a very short breather right here on the Year of Commodities, but come right back. We've already addressed oil. It's time to move on to metals. That's what we'll do when we return.
Welcome back. You're still watching Year of Commodities right here on ET Now. And before going into break, we gave you a detailed wrap of what transpired in the oil markets all of this year. But Mubina, let's shift our focus on the next most important commodity. It's the metals pack, of course, and a lot has happened this year in terms of not only corporate developments, but also a lot of macroeconomics that played out and impacted the metal moves.
Oh yes, undoubtedly. So much has happened in the world of base metals. Aluminium went from a level of $2,500 per ton, and now it's at a level of below $2,000 per ton. And a similar momentum has been witnessed across even the ferrous metals pack. The massive move in iron ore, the massive move in Chinese steel prices. In fact, the ferrous metals have actually entered bear territory. So it's been a very volatile year. It's been a very eventful year as well for the commodities pack. Let's bring on board my colleague Vivek Iyer then to encapsulate everything that happened in the world of metals in 2018.
Well, if you're talking about 2018, it's been an extremely tough year as far as most of the metal stocks are concerned, most of the metal indices are concerned. It's been a dull year, but the main reason for that is if you're looking at how the global demand and supply is panning out, we are more coming towards the end of what can actually be called the end or the end cycle of the entire commodity up cycle that we've been witnessing over the last 3 to 5 years. In terms of how the entire LME index has panned out, it's been a significant downfall, and in fact if you're looking towards December, it's been a sharp correction. Now if you're talking about what actually has happened and the different kinds of moves, different news triggers that actually happened that helped or aided demand as well as supply. In March we saw the Aluminum alumina mines run only at 50% capacity. In April the US actually went ahead and put sanctions on Rusal, thereby impacting almost 50% or significant amount of what the global alumina supplies were. Now again, Brazil went ahead and shut down the Aluminum, thereby operating at half capacity. And over and above that, what actually happened is that we saw the start of the trade war impacting prices globally and in a very, very tough manner. So US went ahead and imposed tariffs as well as on steel as well as aluminum imports, and this was something that had a significant significant impact on the global demand supply scene. Now again, if you're talking about not just alumina and steel, zinc also was something that you saw moving quite significantly. Copper prices went ahead. You saw Indian companies like Hindustan Copper enjoying the benefits of copper pricing surges. But overall, if you're continuing to move towards the end of the year, October, November as well as December, you're actually seeing steel prices entering the bear territory after correcting almost 20% from the top. And what was the reason for that? Because of the fact that the US continued to extend deadline for complying with sanctions in terms of Rusal. You actually saw the China slowdown fears returning. You actually saw demand in terms of steel going down, and which is why 2018, we are ending 2018 for the commodity pack on a very, very sober note. And let's see in 2019 whether you can see some amount of revival in terms of demand, and whether the trade tariff war is, again goes on the back burner as far as 2019 is concerned.
Okay, well, thanks Vivek for that encapsulation. But on that note, let's introduce our next guest on the show, and that's Paul Bartholomew. He's a senior managing editor for metals with S&P Global Platts. Paul, it's a pleasure having you with us on the show. What can we start off with when it comes to the news on metals? I mean, I think if I had to look back at 2018, the one person in the one country that really had max impact on the metals and the way that complex has moved has actually been President Donald Trump, whether it's with respect to the sanctions or whether it's with respect to the trade war. How big and how dominant a factor has Trump and his tweets been on the way metals have moved?
Yeah, he's certainly kept us all busy at our jobs this year. That's for sure, and put sort of steel on the map. Certainly, probably for the wrong reasons, but yeah. But what was interesting, I think, when the tariffs were first introduced in the US on aluminium and steel, it had a little bit of a sort of negative effect, particularly on sentiment in China. But then the markets pretty much got back to fundamentals. I suppose we've seen big impact on countries like Turkey, which has been sort of hit twice in many respects by the US. What you sort of get is a kind of knock-on effect. So some of these countries like Turkey, suddenly they can't export to a major market of the US. They have to suddenly find new markets, and you get all this material, all this steel and other commodities coming into Asia and all kind of competing with one another. But while all this stuff was going on, China was chugging along happily. Very strong domestic demand, but that's all completely changed now. So whether we can attribute the weakness we've seen in China to what's going on with the US, I'm not sure. I mean, that's obviously playing out in the background and that's affecting sentiment. But I actually think there are also some other things going on within the Chinese economy. So we've seen a real slowdown in some of the consumer segments. Chinese aren't buying so many cars, they're not buying so many fridges. This is all having a knock-on effect on metals, of course. So there's actually, there's been the external factors, the Donald Trump factor, but there's also stuff going on in China that's probably independent of the US situation.
We'll come to China in detail in just a minute, but before that, since you mentioned about the fundamentals, just want to understand how are the fundamentals looking at this point of time going into 2019? There are many base metal inventories at their multi-year lows. How do you see the situation play out going ahead?
Well, it's interesting because, if you sort of asked me the same question sort of back in July and maybe early August, I would have said, well, everything's looking sort of fairly okay, notwithstanding some of the issues I just mentioned. But now they don't seem to be looking very good. So we've seen steel prices, so rebar, the steel that goes into construction, that's come off about 20% since I think sort of since late August, and that's a big one because obviously construction and property construction is the big sort of driver and kind of economic bellwether in China. As I mentioned earlier, some of these other sort of manufacturing segments aren't doing very well either. And of course, I think that just the general sort of dampened sentiment has an impact on all of the metals at the moment. So, I mean, I'm sort of wondering to a certain extent, particularly with steel, where there's been a bit of a price correction because China's talked a lot about all the supply cuts it was going to have to try and keep pollution down over winter. And I think the market probably got a bit overexcited and put too much, and prices sort of ran up too quickly. Now they're sort of coming right down again, and there's been some correction. But I think it's also, as I mentioned earlier, just a lack of demand. So I think going into Q1, it's looking quite weak, particularly when you've got the Chinese New Year on February the 4th. Everything sort of slows down. You've got the winter months, construction comes right down because it's too cold to build. So I actually think Q1 is looking sort of pretty soft. So I don't see any kind of recovery to metals prices, and certainly not for steel. Not until maybe later on into the middle of next year, if that.
Okay, I'll just put in an interesting point since you spoke about a recovery in steel. Yes, while the macroeconomic indicators have been pointing towards a slowdown in China especially, we were just dissecting the internals and it looks like China's fixed asset investment, I think for the third consecutive month, has been a positive. It's an uptick, and I think that is something that the market is seeing as a positive. So clearly the government is sort of building up on infrastructure in China. Don't you see that providing some support to the steel markets?
Yes, definitely. So, I mean, what sort of China's been doing this year is, particularly around infrastructure, they've been trying to sort of, get rid of a lot of debt. They're trying to stop the sort of provincial governments from building, new railways, new airports they don't particularly need. So there's been a big slowdown. And now I think what's happened is the economy's sort of been going too slowly, like in second gear or something, and now Beijing is kind of ramping up through the gears, trying to get some activity and action happening again. And infrastructure investment is a big part of that. But in a funny sort of way, it's not as big it doesn't have as big an impact on some of the metals and steel as just building apartments, and just making cars and some of those things. So it will definitely have a positive impact, but there will be a bit of a lag. But I think it also sort of demonstrates that while everyone talks about China transitioning into more of a consumer-driven economy, we can kind of see what's happened if if you rely on consumers, and Beijing's had to step back in and start pumping in a lot of funds and a lot of liquidity into the system, because as the ordinary sort of people just were finding it harder to buy cars and to get funding for cars. There's a lot of liquidities come out of the system. And now, China's doing what it always does and stepping up investment into infrastructure to try and get things moving again.
Like you said, there has been that slowdown coming in the headline numbers for China. Do you believe that will put pressure on China to ensure that they enter into a more permanent deal, a more permanent truce with the United States? We already do have those aluminum and steel tariffs that have been imposed. So do you think that we may see a trade war perhaps coming closer towards an end, and in turn that impact on metal prices?
It's a tricky one, I think, because I think what China's realised is that I think initially they were quite positive about the Trump administration. They thought it was someone that they can do business with, but I think the realisation has now dawned on China in recent months. Well, actually, no, the US is actually trying to keep sort of China down. So I think there is quite a fundamental schism between China and the US at the moment. You're going to get these sort of little short-term or periodic sort of arguments, and then maybe a handshake and something looking more positive. But I think the general outlook for the relationship between China and the US is going to be a bit fraught for quite some time to come. So I wouldn't say there's going to be an overall end to that sort of trade conflict. I think it's going to bubble on for quite some time.
What is the key risk you see for metal prices from here on for 2019? What is going to be the key risk or challenge, rather, according to you?
Yeah, I think it's really that whole sort of that whole sentiment, really. I mean, China in particular is very, very sentiment driven. You have a lot of, mums and dads, investors who getting into the futures markets. Whether it's iron ore, whether it's steel and other things. They sort of play the markets a little bit. And they tend to be very sort of reactive when there's any kind of bad news or good news. And a lot of these futures prices does have a sort of flow-on effect to physical prices. So I think it's really that uncertainty around China, because I think everyone's a little bit surprised at the moment by the speed in which China has come off the boil. So I think, whilst demand is very sort of soft in China, and there is this sort of global socioeconomic sort of tension going on. I think that's the problem. When people don't know what price is going to be, whether it's going to go down again, as I said earlier, they just kind of sort of wait on the sidelines and just sort of hold back off buying, and obviously that has a depressive impact on prices.
Okay, Paul, just need a closing comment from you before we let you go. What's the kind of outlook that you have for base metals going into 2019? Which are the metals you believe will outshine their peers next year?
Yeah, it's a bit sort of tricky, that one. I think they're all influenced by, I think, the same thing. And I say the demand is the outlook is not too sort of positive. I think people sort of still see things like copper as being good sort of longer term. And we're looking a lot at things like battery metals at the moment. That's a big sort of growth area in China. Things like sort of lithium and some of those, where there's a lot of demand, a lot of move towards electric vehicles and that kind of area. But I think most of the prices, whether it's base metals or ferrous prices, are all going to be sort of influenced by similar factors where China's concerned.
Okay, electric vehicle, battery makers, cobalt, nickel, lithium, I think that's what Paul is essentially flagging off for the year to come. On that note, Paul, it was a pleasure chatting with you. Thanks so much for joining in on ET Now's Year of Commodities.
Thank you very much. Thanks.
Well, there you have it. That, of course, was Paul Bartholomew of S&P Platts. Not too optimistic of metals in the year 2019, but, Karanya, we're coming off of 2 years where it's been very tough, very good rather, and now, of course, 2018 not been a good year at all for commodities. Let's see what 2019 has in store. For now, we just need to keep our eyes out on Twitter, see what President Donald Trump is tweeting, because he has been the most influential factor. But with that, it's a wrap on this edition of the show. Thanks for watching, and of course, wishing all our viewers a very happy New Year.